So hi everyone, welcome to the REA Media webinar today. We're very lucky to have with us our Chief Economist of the REA Group, Nerida Conisbee, and thank you all for joining. I think we have around 200 folks from around the media and marketing industry on the call, so thanks for joining us. Obviously the aim of us getting you all together today is to provide you with an economic update on the impact of COVID-19 that we're seeing on the property market. We have run a few of these, so the tech should be okay, people. If it finds it drops out, be patient, it will drop back on. And obviously through the session, you can put questions into the Q&A box and we'll have a session for Q&As at the end. I hope you're all well and safe, but without further ado, I'm going to hand to Nerida to take you through the update. Thank you, Nerida.
Thanks, Paul. So thanks everyone for joining us today. As Paul said, I'm going to be running through an economic update. So I'll just give you a snapshot of where we are up to now. But I'm also going to talk through a lot of the data that we're seeing at the moment. So at the moment, it really hasn't hit pricing. So we aren't really seeing much of an impact on pricing. It's probably going to come, but we are seeing quite a few changes in terms of how people are searching and how people are listing on our site. So I will run you through all that information. So bear with me while I just get my presentation up. So I guess just starting off with a recap of what the government is trying to do now. So they are spending lots and lots of money. They are trying to stem the job loss. So they do want to make sure that as many people don't become unemployed as possible. And if they do become unemployed, that they are well looked after. And so a lot of the initiatives that have been put forward, like increasing job seeker, the job keeper program, all of those were really designed to allow money to continue to flow around the economy and just to make sure that more of us don't become unemployed. They also want to make sure that businesses are supported. They want to prevent bankruptcy because, again, we are expecting this to be a pretty short, sharp downturn, and the fallout will be more limited longer term if we make sure that businesses don't go bankrupt in terms of, over the next 3 months. So given that many businesses have gone from earning decent amounts of income to potentially earning no income, it's a pretty hard job, but there is a lot of money coming through from the government to try and prevent that. And then finally, the final part of it is really just to ensure that the financial system remains stable. We don't have a financial crisis. It is actually quite different to previous downturns in that the financial system is in really good shape. We do have a government who has a surplus. It won't be a surplus anymore, but they have gone into this with a surplus. So there's no shortage of money. We don't have a financial crisis. We do have a productivity crisis. It is just very, very hard with all the social distancing measures for people to do their jobs in the same way that they did them 3-4 weeks ago. So much stimulus. So I'm not going to go through every single element of stimulus available to people because it is a long list, and I'm sure you can obviously go online and read through exactly what is being provided. But it is equivalent to 16.4% of GDP. So to put that into perspective, during the global financial crisis, the government stimulus was equivalent to 4% of GDP. So this is an incredible amount of money that is being provided by the government to really try and make sure that we get through this unscathed. I said before, there's lots and lots of initiatives available. I guess in terms of property, there's a few things that are really positive for property. The first one is the fact that finance is very cheap at the moment. The banks are open for business. This is quite different to when we were in the global financial crisis, very different to when we were in the early 90s recession, that banks were in a lot of trouble at that time. This time they're not in trouble, have been quite vocal in saying that they are well prepared to weather what we are going through. The other thing that will really help the market too is the fact that mortgage payment freezes have been put in place. So this is a real positive for many people because we do expect the downturn to be quite short. It is unlikely to go longer or as bad as this for 6 months. So if it is short, it is important that people are supported over that short time period before they can get back to work like they did. And the fact that mortgage freezes have been put in place is really good. It will also put a cap in terms of how far prices will fall. So I'll talk a little bit about that in a sec, about how if you have a look at markets that do go into free fall in terms of price declines, they do tend to have a collapsing financial system, and they also have people that go into severe distress in terms of trying to pay off their mortgages. We do need some more work on the 6-month tenancy eviction freeze. I think it is creating a lot of problems, not just for renters, but also for landlords. And it is likely we will see more announcements in coming weeks. I think from the commercial property side, I'm not talking about that today, but from the commercial property side, we are expecting an announcement today in terms of what they plan to do with the tenancy eviction freeze and what is appropriate and what isn't appropriate in terms of what rental payments are. At the moment, you should ignore any forecasts of price declines. We will probably start to see a lot of doom and gloom scenarios coming out over the next couple of weeks. I think when we have a look at the last downturn, the ultimate one was the bricks and slaughter scenario that 60 Minutes put forward. But at the moment, nobody knows. It is just a complete unknown as to how far prices will fall. It is naive to think they won't fall. At this stage, we are heading into a situation of pretty high unemployment. So in that situation, people do, and also very high levels of uncertainty, people are unlikely to transact as much in such markets. So it will impact pricing. In terms of what's different this time, I guess, firstly, again, coming back to that government stimulus, it is unprecedented. Those mortgage freezes will really help. Very different to what we've seen in previous downturns. I mentioned before that this isn't a financial crisis, so it is quite different in terms of what's been happening. And then I guess the impacts will be highly variable across Australia, depending on where you are. So when we have a look at previous downturns, in the 1990s recession, we did see big drops in pricing in Melbourne. So Melbourne and Adelaide were hit really hard by the recession. If we have a look at the Gold Coast at that same time, we did see quite strong price growth in the Gold Coast as a lot of people moved up there. When we have a look in the GFC, the global financial crisis last decade, or decade before now, we did see premium markets of Sydney and Melbourne do quite badly. So again, it's all generally related to employment loss. So at that time it hit people that were in very well-paid finance jobs, and they typically do live in more expensive parts of Australia. And then more recently, the Financial Services Royal Commission and the election uncertainty last year did lead to big drops in Melbourne, Sydney, but Hobart saw the highest level of growth it had ever seen. Adelaide remained pretty stable, Brisbane remained pretty stable. So again, when people come out with these broad brush forecasts, you do need to be mindful that they won't hit every market in the same way, and some will be more impacted than others. So what could happen to pricing? I guess some early thoughts. I mean, this will change, and I guess this is a thing with what people are, what all economists are really grappling with at the moment is, what will be the eventual fallout across a range of measures. And I guess for me, my main focus is really looking at property and pricing and rents and the like. I mentioned before the number of distressed sales. We do expect far fewer distressed sales to take place, primarily because of those mortgage payment freezes. We would see far bigger drops in pricing if we didn't have that in place. We do have employment growth in some sectors. So, we are seeing rising unemployment, but if you're in the health industry, you are unlikely to be made unemployed anytime soon, although it does depend on what sector of the health industry you're in. If you're in government, we do expect significant growth in some departments. Tax Office, Centrelink, Department of Health, for example, would be areas that will need more people to be able to deal with what's happening and really to help with the stimulus package. In terms of those areas that will be most impacted, obviously tourism and education are the big ones. So tourism in particular, any markets that have been that are heavily reliant on tourism are going to have a longer impact. Will have a much longer economic impact on them over the next year or so, compared to those that are more reliant on government. In terms of what markets could be beneficiaries, I guess Canberra is probably the main one. We are seeing quite different search behaviour at the moment in Canberra. compared to the rest of Australia. We're seeing some decent rental searches in that area. We're seeing quite a lot of views for new developments in Canberra, which is highly unusual because we're just not seeing that elsewhere. But I'll show you some data on that in a sec. In terms of a wild card, it could be Perth. I think Perth is it has been pretty good at shutting down their borders really quickly. So I don't think they'll be impacted quite as much in terms of a health crisis. But what the real beneficiary for Perth will be is the fact that iron ore is still being exported, and more of it will be exported to China, given that the Chinese economy is slowly getting back to normal. The level of exports is actually expected to reach $100 billion this year. So that's actually the highest export that we've ever done of any product in Australia. So very good news for Perth. The other beneficiary for Perth will be gold. So gold prices now are at record highs. It is a product that people buy when they are feeling very nervous about the market. So gold is seeing very high demand, very high prices, and in 2021, Australia will be the biggest producer of gold in the world. So again, most of it's coming out of WA. So it could be, again, kind of like what we saw in the global financial crisis, where Perth really didn't tumble at all. Perth did actually really well through that time period. Obviously didn't do that well once things started to slow down in the mining sector. But I think for now they will be a little bit more protected than some other markets across Australia. The one area, again, coming back to what we're seeing right now, things are really tough for renters at the moment. There's lots of reasons for that. I guess the main one being is that they are typically younger, they are less financially stable, so many of them don't have high levels of savings that they can draw upon for prolonged periods of time. They're also more exposed to the sectors of the economy that have seen the most immediate hit. So the hits from COVID-19 will be spread, further. We do expect it to be to not just impact certain sectors, but at the moment, if you're in hospitality or tourism or entertainment, you're probably not working at the moment, and you're probably having to rely on government to be able to get you through this time period. So a lot of those people in those sectors are younger; they're more likely to be renters. We are starting to see an increase in search on flatmates.com.au. So that's a share site that we own, and it does look like people who are renting are really trying to minimise their costs. So those renters who are lucky enough to be able to move back with parents, we do think that is probably happening. We can't track it, but we can certainly see that on Flatmates that more people are looking to share to really try to get through this time period. I guess the big one is now about renters and landlords, and so all this rental stress, if it's not handled properly, if renters do go into a situation where they can't pay their rent or aren't supported through this time period, it will be passed on to the investor market. So a big problem will become an even bigger problem. So what we're seeing with renters, we are seeing an increase in rental listings. You can see there in March. That's not actually full March 2020 figures. I took that data yesterday. It takes a little while for us to get the full read in terms of how many rental listings are on our site, but you can see there that the increases that we're seeing. The one area seeing a decline in rental listings is Canberra. So Canberra rental listings are actually down 11.3%. Again, coming back to some of that funny data that we're seeing in the Canberra market, which is quite different to the rest of Australia. But everywhere else, you can see Melbourne or Victoria up 15.2%, Sydney up, New South Wales 12.1%, Queensland up 8.9%. So it is partly driven by the fact that people are looking for alternative accommodation. It is also due to short-term rentals moving to long-term. So if you had an Airbnb listing, you're probably not going to be finding someone to use that listing, that property. So if you had an Airbnb property, you're probably not going to be able to find someone to use that property anytime soon. And so we are seeing this switch of furnished, we're seeing this big increase in furnished rental listings on realestate.com.au. And particularly there in Queensland, which is a market very dependent on tourism. So we do expect to see a bit more announcement around how landlords will be, what sort of incentives, I guess, support they'll get through this time period, particularly with the 6-month eviction freeze. There's lots of things being talked about, whether there's some changes to negative gearing or land tax or stamp duty, or probably not stamp duty, but it's likely to be something that will be provided to them to help them get through if their property has been impacted by from COVID-19. For sale listings, we're finally seeing some recovery. This has been a big problem for us. Obviously, it's been a big problem for the property industry as well, that people just haven't been buying and selling as many homes as they have previously. It's also a bigger problem economically that on one hand, people will often look at price growth as being an indicator of a good property market, but the reality is that price growth is only good if it leads to more people buying and selling properties, because that's really what creates economic activity. We had this amazing start into March, so you can see there that for March there was a big pickup in listing volumes, particularly Melbourne, Sydney, Hobart. It was very much concentrated around those markets that had been seeing some very, very strong price growth. So premium markets in Melbourne and Sydney were doing very, very well in terms of price growth, and that did extend on to, it was finally starting to extend on to listing volumes. It is likely we'll see fewer listings. Things are highly uncertain at the moment, so people do tend to not transact. And then also, I guess on the negative side is, which is actually a good thing, we are less likely to see distressed listings, because that could potentially lead to a big uptick in people selling. But because of again those mortgage payment freezes, that will really help out there. There's some data that's coming through from markets that have been far more adversely impacted than ours, and I guess the main ones are Italy and New York. Italy, it seemed very, very positive initially, so I don't know how reliable this Italian Real Estate Institute is, but Real Estate Research Institute is, but in January, February, they said there was a 7% reduction in listings in Milan and a 12% reduction in Lombardy. So just doesn't include March, and obviously things really took a far worse turn initially in March, but it seemed pretty light on from what most people are expecting in terms of rental listings. In terms of New York, I did hear that there was around a 50% reduction in listings in March, but I don't have a source for that. So New York is obviously a hugely impacted market at the moment and has virtually gone into shutdown. Does it feel like Christmas? It probably doesn't, not in a nice way anyway, but what we're finding on site is that buyer search activity is vaguely looking what we see at Christmas time, that Christmas New Year time period. So Scott Moran has been talking a lot about putting the business world and the economy into hibernation, and that certainly is a similar theme to what we're seeing. So it's not shut down. We can certainly see that people are still selling, they're still looking to buy, they're still very interested in the property market, but it's just not that super volumes that we were seeing at the start of this year. So we were seeing these record levels of search activity in January and February, but things have slowed down. But we're watching it really closely. I think what was interesting, it hasn't slowed down as quickly as I expected. Even till last week, we were seeing high levels of search activity this year for that week compared to the same week last year. So it was still up about 8%. This week it has come down compared to the same week last year, but it's only around 6%. So things were very, very dire for the property market this time last year. We did have the Royal Commission on, and we did also have a lot of uncertainty with regards to government change. So it's slowly getting worse than last year, but it's not moving as quickly as I would necessarily expect. We have a look on a state-by-state basis from buy. Rent's quite different. I mentioned Canberra before, but for buy, it is broadly similar across states. South Australia looks a little bit worse, but it's too early to read much into it at this stage. In terms of inquiry levels, this is something we've been looking at more closely. Again, we saw a drop-off. We saw around a 20% drop-off in first home buyer inquiries in March. But what's interesting, it's not everywhere that's seeing a drop-off. I mean, often also the same way that we talk a lot about price growth and how, you really can't read anything into national forecasts of price growth. The same is true once we get onto a suburb level and also onto a property type level. So at the moment, we have seen this drop in inquiry, but there are some locations that are still looking far more active than others. And I've just put up the top 10 there, but you can see that first home buyers very much concentrating on certain price points. They do get more incentives available to them when they buy in certain price points. Quite interesting though, the Melbourne unit market is sitting there. Melbourne CBD units are sitting there at number 1. So probably a lot to do with affordability. They're quite cheap, but also I guess particularly well located. The other interesting thing is you can see that 50-50% mix between units and houses. So it's quite an even mix in terms of what first home buyers are looking for. Investor activity has dropped more. We've seen a drop in inquiry of about a third. But again, not the same everywhere. So that there are some locations that people are particularly focused on at the moment, possibly looking for value, I guess. We know that a lot of people are hoping to see quite significant price declines so they can get into the market at a far cheaper price. At the moment, again, you can see that the price points are kind of similar to what we see in for first home buyers, but very dominated by the unit market. So Surfers, Paradise, Melbourne, Brisbane, CBD, sitting there at the top 3 in terms of what people, investors are inquiring on. Just as a explainer, inquiries when you go onto a listing on our site and you click on email an agent and and when you get to that form, you can actually specify what sort of buyer you are. So it does give us a little bit more richer detail compared to search, which basically just shows us that somebody searched. This does give us more detail. It also shows a high level of intent, that when people do look at, when people email an agent, they are typically further down the buy process. So going on to most in demand. So these are views per listing on our site. So again, some locations now are seeing very, very high views per listing. I think Hawthorn is seeing around 12,000 views per listing on our site. What seems to be happening is buyers are again going back to very, very expensive locations, and I'd say that they're probably looking for value in those locations. So what was happening end of last year, we did see a fairly similar list coming up from where people were searching. It was dominated by places like Hawthorn and Albert Park and Paddington in Sydney. Towards February, we started to see people sort of spread out into other locations that were far more affordable. But it does look like those premium suburbs are again coming back. So yeah, again, likely people just looking for bargains at a time when, I think potentially people are looking for lower prices in some locations that are highly desirable. When we have a look at renters, rental activity does tend to show up locations young people like to be in. So Fitzroy North is obviously one of those. You can see there too, Southern Gold Coast is continuing to feature as a high demand area from renters. So that's continuing to happen. It is an area that is rapidly changing in terms of search activity. It also does reflect a little bit to do with the types of economic growth that areas are seeing. So you can see there are a few more affordable locations in Adelaide on the list, and we've seen that for quite some time, that there's a quite strong rental demand and probably a bit of a rental house shortage in some of the more affordable locations in that market. Offshore buyers have really backed off for now, even Hong Kong. So Hong Kong was accelerating for a long time, ever since they were starting to go through some significant economic uncertainty. So they've come off. The other big one that's really come off is New Zealand. New Zealand searches have always been very, very high on our site. We particularly in the Gold Coast and particularly in Queensland, we see a lot of search activity coming out of New Zealand. So that's dropped off, not surprisingly. And also China. So China is the market that has the most influence on the new home sector, particularly apartments. They never really came back from 2017. So we haven't really seen much of an increase in activity from there. We did see a bit of a pickup last week, but it's dropped right back again. So they do seem to be looking a bit, but there's certainly no surge back in activity. The developments that people are looking at, I mentioned before Canberra, this seems to be a bit of a theme at the moment around what's happening in Canberra versus the rest of Australia. Views of new development were actually up in Canberra and Sydney, so that was quite surprising. They were down everywhere else. But there are certain projects that people are a little bit more focused on at the moment. So Palm Beach coming up there, we've got the Harrington Collection in the Rocks, quite a couple of developments in Melbourne that people are looking at. And then when we get to inquiry levels, it does look a little bit more first home buyer focused. Schofields and Edmondson Park coming up there, and North Kellyville. So house and land in up until the end of Feb, house and land in Sydney was red hot, but it looks like it's still an area that is seeing fairly high levels of inquiry at the moment. So I'll just finish up with a couple of things, just fun things, I guess. The most viewed listings on our site over the past week. So this was the most viewed rental listing, again, a Canberra one that we're seeing lots and lots of clicks on. Pretty nice property, pretty expensive for Canberra, $1,200 a week, but again, likely reflecting what's happening in another, I guess, data point that seems to reflect what's happening in Canberra versus the rest of Australia. In terms of properties for sale, I think this may have been a little bit of a dream listing. So Byron Bay, beautiful house there, to 2.2 million. So not sure if it was an Airbnb listing. I think it's probably a little bit too early for any Airbnb listings to be coming on board, but was one that did see particularly high levels of activity over the past week. So I might finish there, and I'll get Paul to come back and we'll do some Q&A.
Hi everyone, and thank you, Nell. I think you'd all agree there's some really key information there that we're finding from the market, and obviously our aim is to provide that to you as our customers and help you through this period. We did have some questions come through, Nerida, in the pre-registration link, so I'll start there, and then I think there's some coming through on the Q&A. So if you'd like to ask a question, guys, jump into the Q&A function. It should be down there at the bottom of your screen. But Nerida, I'll kick off with a question that came through. In this period and this climate, are we expecting consumers to therefore be staying in their homes longer? And if so, do we think that we'll see a pivot to people renovating, whether it be mini or large, more, and adding to looking to add value on their homes?
Yeah, I mean, Bunnings is doing record trade at the moment, so it does seem to be something that people are stuck at home. They're looking at where they're living a little bit more closely. I know I've certainly been cleaning my house a lot more than I usually do because I'm hanging around there more. So yeah, I do expect it is likely renovation activity will continue. It's been interesting, even building activity is continuing. So that's been classified as an essential service. Building sites are now operating 24 hours, 7 days a week if need be. So I think given the importance of the construction industry, that will likely continue unless things really go bad. So yeah, good news for anyone renovating with all that extra time, and it has been also good news for retailers that are able to cater for that market.
Thanks, Nerida. Just looking at another one. Do you foresee a large drop in house prices during the COVID-19 period? And if so, do you have a prediction on where it might go to?
Look, at this stage, it's very hard to understand exactly what the impact will be. I think, coming back to those parts of Australia that will be more protected, I think somewhere like Canberra will do okay through this. They may see price declines, but probably not as much as some other markets. If you have a look at the other extreme, a market like Hobart, Hobart has been an incredibly strong performer over the last 4 years, primarily because it has suddenly had this new economy based on tourism and entertainment and education. And given what's happened with COVID-19 is that a lot of that has stopped completely. Tasmania has closed its borders. It will really impact that part of the market. So don't expect to see such positive price. It's quite possible that that Hobart will take a bigger hit, and will probably take a bigger hit than somewhere like Canberra, which is more protected by government. At this stage, it's I guess the big factor that will protect pricing is the mortgage freezes that banks are putting through. So even if people lose their jobs, on one hand they will get more government support than they otherwise would, but also they're able to put a freeze on their mortgage payments, so they won't go into financial distress as quickly as we would have seen if the banking system wasn't capable of doing those mortgage freezes. So, I think this is the thing with pricing. It's really hard to tell at the moment, and I'm looking out closely for anyone that's doing sort of more micro level forecasting. So, groups like Urbis or Deloitte, they do tend to look at a little bit more of a bottom up approach, and because trying to use macroeconomic variables to forecast pricing is not going to work in this market. We really need more of a micro analysis to be able to work out what's going to happen.
Okay, thanks, Nerida. Looking at our next question, I like this one. So, do we anticipate seeing an influx of foreign investment with the Aussie dollar so low, or will current and potential future government restrictions curtail this?
Yeah, so the federal government is obviously looking out for this to prevent this happening, and you don't want to have a vulnerable economy and then have a lot of foreign takeover activity taking place during that time. So the government is looking at any Foreign Investment Review Board proposals far more closely than they have in the past. So I guess that's a factor. I don't know. In terms of overseas buyers buying apartments in Australia, I can't see that coming back anytime soon, and partly because it hadn't come back already. So, if you have a look at last month, it wasn't like we were suddenly seeing this rush of activity coming out of Singapore or China or whatever. So it wasn't happening. There may be some buyers that are feeling a little bit cashed up, but the other problem is that the shutdown of borders is preventing people moving around. So, we don't know how long that will happen or will continue to go on for. So, in terms of being able to actually look at a property and get a clear idea of what you're actually buying is a lot more difficult than it used to be. And so, there's a lot of activity I think won't happen, and I think potentially some foreign purchases of Australian property will be one of those because of our border shutdowns.
Thank you, Nerida. We're still good on time. This question, if the scenarios were to be grouped into quick 3 months, medium 6 months, and long recovery being unknown, what would be the likely duration of the long recovery, and what would be the strongest first indicator that we're heading that way?
Look, I suppose, personally, I've been looking pretty closely at a number of new cases that are coming through, and I think it was interesting talking to or hearing some of the feedback from our Hong Kong office. So Hong Kong has been, we own a portal there, Square Foot, and Hong Kong has gone through the SARS crisis. So they came into this, that was in 2004. So the Hong Kong government came into this a lot better prepared than say we did, because we've never experienced something like this happen before. And what's been happening there is they basically have been monitoring what's been happening with the virus, and as things start to improve, they start to open things up. If it starts to get bad again, they shut things down again. So I think worst case that's what we will be in for the foreseeable time. Not worst case, but for the foreseeable time, I think that's what we will be in for. Primarily because I'm I'm not confident, but I'm looking at those rates of new cases. It's not accelerating in the same way that it was accelerating before the shutdown. So, hopefully we see this kind of process where we're kind of a little bit drifting in and out of shutdown versus less of a shutdown. And then, longer term, it's all about finding a vaccination. Viruses can come and go. I suppose I'm no expert in any of that, but there is, there's lots of things that can happen with the virus itself.
Thank you, Nerida. Next question on our channel. What's your advice for those that may be looking to build new homes in this current? Do we wait or build now?
Oh gosh, I'm actually in the same situation. We were due to knock down in about 6 weeks. So I don't know. We're trying to just hold the process off as long as possible, hoping that as we get closer to the date, we've got a little bit more certainty. I suppose it depends on your employment situation. That's a big factor. But yeah, it's a highly uncertain time. I mean, the building industry, I suppose, in terms of actual building taking place, I'm more confident that the building will take place. So that was a bit of a concern initially, but at this stage, it does seem like the building industry is open for business and things are going ahead. I think it's probably more around your own personal situation, and how comfortable you are with taking a risk in terms of going ahead with anything.
Okay, thank you, Nerida. Next question. Interest rates have been falling since the 80s, which has helped drive property prices. They are now near zero, and the government resorted to fiscal policy to stimulate in the current crisis. Can property prices continue to appreciate over the longer term without monetary stimulus support?
Yeah, okay. So finance is one driver of property prices. It's also supply and demand are the other two. I suppose once we come out of this, it's highly likely we will see a surge in pricing. And the reason being is that interest rates are incredibly low. The banks are being very prepared to lend at the moment. But also there's just this incredible amount of fuel from fiscal policy that will really force our economy into growth very, very quickly. It could even be that the economy overheats, but I suppose at this stage nobody really cares too much about it because we really want to get through this next few months and prevent job loss and prevent firms going bankrupt. So I do think it's highly likely we'll see quite a strong shoot up in pricing once the economy rebounds, and then we're going to have much different problems at that stage. So it will be around trying to unwind that stimulus. It'll be around how do we pay? There's now some talk around GST, and will there have to be changes to the amount of GST we pay to be able to pay back all this debt that the government is taking on? So there's going to be some things that we come out at the other end and say, why did we do that? But at this stage, everyone's flying blind, and we're really just trying to prevent a crisis in the economy.
Thank you, Nerida. Next question here, which I think is something you'd be interested in because we've chatted about this, but would you say that with the fear of negative interest rates or interest rates being so low and record levels, that property investment and bricks and mortar is probably a better option for people with money in the bank?
Yeah, look, this is one thing I think will be another factor in preventing massive drops in pricing. So I think the main one will be those mortgage freezers, but in times of uncertainty, property is an asset class that people look to, and we're seeing it a bit we are actually seeing it in commercial property at the moment. So this morning I had a look at some of the views per listing on our site, and farming is still seeing very, very high demand at the moment. So I suppose coming back to what do people need in a crisis? They're still going to need food. So it's it's important that so some people are seeing, farming as a good option. We did see quite a surge of activity in medical centres. So, people are kind of taking a punt on the fact that once this is over, then, we will see a lot of investment in medical technology, and we will see a lot of investment in making sure our hospitals are well equipped to cope with a similar crisis in the future. So, so I think property, it is a safe, it is considered to be a safer option. I think probably residential, there'll be a few factors that prevent people buying as a safer option. It's obviously not as safe as people think US dollars are or gold is. They're kind of seen as the ultimate safe havens, but certainly is probably less of a risk buying a house at the moment than buying shares in Myer or shopping centre owners or whatever. So there are different elements of risk, which I think property kind of sits in the middle of.
Right, thanks, Nerida. The next question here. Is there any data on contracts falling over on a finance clause? This appears to be one of the biggest issues at present.
I haven't heard. I mean, I've heard. The stuff coming around in finance seems to be mostly positive, is what I've heard. So yeah, that's not something I've heard at this stage. I've started to hear banks, starting to change some of their mortgage insurance products. So I guess that might be a little bit reflective of the fact they consider this market is highly uncertain, highly volatile, and it is hard to provide insurance in such an environment. So there probably will be changes, but yeah, I haven't heard anything on that one.
Thank you, Nerida. Next question, very relevant for our business. I think we've talked about this one again. So with the restrictions on group OFIs and multiple people attending, open for inspections and live auctions, the real estate industry has had to find a way to be creative with digital ways to do business. Do you think this forced digital adoption is here to stay post-crisis? And if so, how does this potentially reshape the category and market?
Yeah, look, it is interesting that, the tech changes that are taking place. Things like online auctions and virtual open for inspections have been around a long time. We launched last Thursday our virtual open for inspection tool. So, we were well prepared in that respect. But I do think what this will do is just drag forward a lot of technology that's been pretty good, but I think it's just going to make it so much better. And it will make the consumer experience a lot better too. I think one of the outcomes of this will be that when you're looking for a home, looking at it physically is, that's the ideal, that we always like to look at our homes before we buy them or before we rent them. But in terms of going on our site and actually looking in depth at a property before you even take that step to look at the property physically, will be a lot better. So, you'll be able to sort through exactly what you're looking for a lot quicker than otherwise would just by looking at photos.
Thanks, Nerida. The questions seem to have dropped off. I might just hold for a couple of minutes to see if we have any more in the thread. My left down here. If we don't have any coming through. So look, I think, guys, we'll probably finish it up there. I just wanted, before you go, we're just going to have a quick poll. So Zoe, I think we're going to show a slide now. We just want to get your feedback from the session today. We are looking at rolling these out down the line in the future. So your feedback from today's webinar is really valued. So please take a moment to stay on the call. And I think the slide should come up on your screens in a moment where you can answer the poll. And look, thank you for joining today. I hope you've found that information update from Nerida really useful. Please the poll, but reach out to me directly should you want to have a further chat. And lastly, please stay in and stay safe. And we wish you all the best. And you should have the poll up on screen now. With that, I would just like to say a huge thank you again, Nerida, for giving us your time. She's very busy doing lots of media interviews, imagine, in this climate. So we thank you for your time. Thank you for everyone in the market joining, and look forward to seeing you all soon. Thanks very much.
Thank you.